Welcome to the LiveSquawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary.
Before we dive in, if you want the news that moves markets delivered in real time, 24 hours a day, check out LiveSquawk. It's our audio squawk service trusted by serious traders worldwide. Start your free trial today at livesquawk.com. No credit card required. Hello and welcome to LiveSquawk's Q2 earnings season preview on Wednesday, the 15th of July. Over the next 30 minutes, we'll be looking at what experts have to say about the corporate outlook and how wider domestic and international dynamics might play into company execs' views and expectations for Q2 and beyond. I'll be joined by a regular contributor to the podcast, Christine Short, Head of Research at Global Corporate Events at Wall Street Horizon, which is a TMX company. Before we bring her in, just a quick disclaimer. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. Hi, Christine. How are you doing?
I am so well. How are you? It's great to be here.
Excellent. Very well, thank you. Thank you for asking. Right. We're getting into this. We're recording this on the Wednesday, just for reference purposes, ahead of the World Cup semi-final between England and Argentina. So if I sound a little bit hurried, it's because I want to finish this and then go watch it. I'm joking. But yeah, that's we'll come to that later. But we are at the beginning of the Q2 earning season, and I want to take from a piece you put out on. You can go to wallstreethorizons.com and pick up this preview. Really, we'll get straight into it. Upper revisions fuel big expectations for the Q2 earnings. What are your initial views or expectations for this coming corporate earnings season?
Well, as you know, because you've read the report, the expectations are pretty lofty. Q2 is currently anticipated to post about 24% year-over-year EPS growth. That's for just the S&P 500. Those numbers are from FactSet, and I will say those are as of July 10th, so Friday. Those will change massively when the next report is reported on Friday because of all of these huge bank beats that we've seen. But let's just take the 24%. That would be the second consecutive quarter of 20+% growth, seventh consecutive quarter of double-digit growth. So just really impressive numbers coming into this. And that's with the support of 12.5% revenue growth. So it's not just the bottom line growth. There's still some robust top line growth happening there. But what I think is most interesting coming into this season was how those expectations got ratcheted up by sell-side analysts, which, as we know, anyone that covers earnings knows that is not the norm. Typically, analysts pull down estimates. You see the overall growth rate estimate drop heading into an earnings season. But for Q2, from March 31st through June 30th, analysts increased S&P 500 EPS expectations by 3.4%, and that was the largest increase in 5 years. We did see back end of 2025, like these very slight, like 0.1% increase heading into the season or 0.5% in Q4, but we haven't seen such a massive lifting of estimates because typically what happens is companies, they're very conservative in their guidance. They want to beat their expectations, so they guide pretty low, right? And analysts just sort of take that information and they go along with it. So to see the expectations rise, and I think if I look at the Earnings Whisperer's recent, if no one's on this, the Earnings Whisperer has really great daily insights on who's beating and who's missing. Okay. And with about 20 or 35 companies reporting at this point, so we're still very early in the season, 94% have exceeded EPS expectations. 94%. So 94, and it's usually around 80. This is still very early, but to have estimates increase coming into the season And then the first 35 companies were beating by 94%. Those increases weren't enough, obviously, right? So it's really just a great setup. And as you know, the banks, all 6 major banks have reported just stellar results. So it really kind of kicks off the earnings season with a very positive tone.
And does that, just on the banking side of things, again, investment bank, again, it has returned. Advisory fees, debt issuance, equity underwriting, all have rebounded sharply. We've seen IPO and M&A activity also improve. So maybe not a massive surprise on the banking front, so to speak. Were there any other factors that you've seen that may have fed into the better performance for obviously investment banks? We'll see some of the more regional banks report over the coming days as well. But just for those investment banks initially.
Yeah, I mean, it's everything you said. The 2 bright spots were investment banking fees. If you just look across the board at some of these numbers, Goldman Sachs, 55% increase in IB fees, JP Morgan, 30%, Bank of America, 50%. So all of those across the board. But as you said, we all kind of expected that, but I think the numbers are even outside of that range. Positive surprises for all of those. And then equities trading, equity trading desks doing very well. At Goldman Sachs, equities trading revenue jumped 72%. I think JP Morgan was 86%. Morgan Stanley was 69%. So those were two bright spots. But again, we expected all of that to happen, all of the volatility throughout Q2. We know trading desks benefit from that. I think the one surprise, well, there was a couple surprises in the bank notes. One was a couple, I think Citigroup was one of them, but a couple of them put away less for loan loss provisions. So that was a headwind. We were expecting them to increase the cash put aside for defaults, right? Because the consumer is still, we keep saying the consumer's resilient, but look, lending hasn't been doing particularly well. Mortgages, credit card delinquencies. And so there was some fear there that, yes, if we have to increase for loan loss provisions, that's going to take a cut out of the bottom line. But we're actually seeing from Q1 to Q2, some of the banks decreased how much they were putting aside for defaults. And then in the credit card piece of it, the consumer credit piece, credit card delinquencies, I think, were pretty steady. What I did see was revolving balances, and that may have been at JP Morgan. Revolving balances, so the amount of money still left unpaid on the credit card at the time the billing cycle ends had increased. So there's still a few. You can pick through the data. It's not as bad as expected, but you can still pick a few points in there where you're like, ooh, okay, that's not entirely great. But so that was one, I'd say, surprise to the upside. And then the other, the commentary, from CEOs, we heard across the board about the strength of the economy. And I think overall a less cautious tone than we did in Q1. So that kind of started off the calls. And then if you dig down into the CFO comments, many of them talked about the strength of the consumer. And, these are the banks should know, like they're in it. But some of that was surprising to me. Bank of America CFO talked about consumers growing average deposits and loans and the consumer remaining resilient. He said the biggest risk of what's going on with the economy and the biggest driver is the consumer, and they're doing really well. Okay, so that's positive. The one sort of, I'd say, cautionary tone on the consumer was from the CFO of Wells Fargo. And while they said, yep, consumer trends have been resilient despite volatility with oil prices, he did remark that if inflation ends up being much higher or rates go up more than people expect, including whatever happens with oil, then that would have an impact on consumers in the overall economy, but they just haven't seen that start to materialize yet. So there was that caveat in the reminder that there is a lot of uncertainty with the geopolitical picture, with energy prices. But overall, the theme was labor market's still strong. That's what's most highly correlated with how folks spend their money, and that whole picture seems to be holding up for now.
Well, you mentioned the geopolitical scene, so I was going to come to that later, but we might as well look at it now because, like you say, we've got a resilient consumer out there, which has been the story for a while. The consumer credit, like you say, remains healthy as well. The geopolitical situation, we'd seen a cessation in the fighting between US Iran about a month, 6 weeks ago, really. It ebbed down, and we were looking towards a peace deal. And we had signed that MOU, for anyone who's missed it, 6-day MOU that now has been torn up by both sides, to be fair. And there's a resumption of violence in the region. Yet although we have had relatively a spike in the energy price, we're not really at the levels we were seeing at the start of the conflict. Do you think, from an inflation expectations perspective, this is now in hand, and this is why we're seeing, I've had a chance to look at the numbers, the CFOs, for example, and the situation at hand, but still looking for decent earnings moving forward. Do you think this is all in hand for the markets at the moment?
Yeah, I mean, CPI came out yesterday. Of course, it was backwards looking for June, and it showed a drop of 0.4%. It was the largest monthly drop since April 2020. But 1 month doesn't make a trend. And as we know, a week later, after June ended on July 8th, like you said, the ceasefire ended. So I look, fresh new airstrikes. U.S. launched new airstrikes against Iran this morning. I'm seeing more and more experts worry about a very drawn out war, right? We haven't, like you said, during the ceasefire, there was a period of, okay, perhaps this is coming to an end. We have a better crystal ball with what's happening in the short term. But now with this blockade and new round of airstrikes, it does start to wonder if this is going to be a forever war and what the eventual impact would be. But you're right, a lot of the earnings estimates are not pricing this in, right? They're pricing in they're pricing in the current environment where this is still going to get, resolved, and there's not enough clarity, I think, to make changes. If you look across, we kind of did a piece on what different companies were saying about, were they suspending guidance because of the war? And there were a few. I think Constellation Brands was one. It was more of they suspended forward-looking guidance because it was more of a consumer-related thing, not so much impacted by the war. But then you look at names like Ford. Ford, they provided guidance without the impact of oil increases. So they're not suspending, but they can't give forward guidance because they don't know what the impact is going to be. And so I think you're seeing more companies change what sort of guidance they're giving, or yeah.
Do you think, from the auto sector, is that they're buffeted by other headwinds? You got the Chinese element to all this with the US automakers as well. They have different headwinds really to as well as the energy element to all this as well. We have obviously tariff hangover as well, maybe a part of all this as well. So there are other dimensions maybe for the auto sector. Would you agree with that?
Absolutely, yes. And I would say in all of the companies we've tracked that have either suspended or withdrawn or made comments about guidance changing maybe as a result of the war, that wasn't the only thing. So like I said, with Constellation Brands, there's a whole host of other issues going on with how people consume alcoholic beverages, or Gen Z perhaps not drinking a lot, and they touched on those. But then and then Ford similarly, Air Canada suspended their full year guidance because of fuel costs, and they couldn't predict those going out. There were some in other sectors like Procter & Gamble delayed when they usually issue fiscal guidance, and they acknowledged that they had concerns around a prolonged rise in oil prices. Right. And so this doesn't have to do with guidance. Whirlpool stopped paying, they suspended dividends for the first time in 70 years. and they blame the Iran war driving, U.S. consumer confidence lower. And they were saying as a result, they were seeing a decline in large ticket purchases for things like appliances. So here and there, if you're reading through the notes in these earnings results, you are finding concerns around the war and if it were to continue, but we don't know right now. And so they're giving the best guidance they can.
Sure. I mean, within your notes, that you mentioned that they expect investors to watch for the further dividend suspensions, and you sort of name checked Whirlpool, and also within it says companies facing sort of weaker consumer demand or margin pressure may prioritize preserving cash over shareholder payouts. They're not, although you're not expecting widespread cuts as of now with that. I wanted to talk margins and the dividend. You sort of touched on that, dividend suspensions, really, and we'll look at the tariffs as well. But I wanted to talk about margins and AI, which is obviously this big factor in a lot of what we're seeing at the moment. And my question was, it's a bit of a convoluted one. I read a report from Morgan Stanley that's published a piece looking at AI backlash and community pushback against data center construction. But the upside was the margins are so good for with the introduction of AI now, that's helping to boost the indices, if you like, but companies in particular. But the other side of that is, again, building these data centers, the energy that's required to drive all this this AI infrastructure. Where are you with that? And is that something, a cloud in the distance? Is that potentially a known unknown that we have to watch out for? And is it something the stock market hawks are maybe looking at down the line?
Yeah, no, it's an interesting topic because you're right. From our kind of where we sit and just looking at the companies, it's like the efficiency, the upside of AI, investors are very excited about it. But you're right, there is this growing dislike. I mean, New York, where I am, just became the first US state to impose AI data center bans. And I think you're probably going to see more of this come up as, people don't want this in their neighborhoods, and the, like you said, the energy costs, people are becoming more aware of what that is. I think from a company perspective, I mean, on the flip side, you see Jamie Dimon the other day just said AI's reduced jobs in some areas by 40%. I don't know that people love hearing that either, right? There's been this growing concern AI is going to take my job, although whether or not that's, is it going to take my job? Is it going to make my job more efficient? Is it going to remove the need for entry-level jobs? It's like all of this is
that's a real fear, though, isn't it?
Seen.
I mean, for some sectors,
oh yeah,
the idea that AI means you stop that apprenticeship. For us, especially in the banking sector, I guess we learned from the old days. I'm talking because I'm an old git. 40 years back when I started in the city in the banking sector, I had to do all the worst jobs that no one else wanted to do. But what it did was inform me and was the base layer of my learning of
right.
what the banking system was. And by doing every single little job at the bottom of the rung and working my way up the ladder, that's how I learned what it was. And if you skip that part and you skip to the next level, there's going to be a real vacuum of knowledge, I think, in years to come.
Yeah, so, I mean, same as an early earnings analyst, I used to have to go through all of the earnings releases and find adjusted versus non-adjusted EPS, and I knew where to look for it in the document. And had I not kind of gone through and read those things firsthand, I don't know that you'd have a deep understanding of how each company calculates their adjusted EPS, or how, I'm not sure how you would start that role without having done that job. How do you jump in? But now that's what's going to happen. There's going to be AI is built to pull all of those numbers out, but you're not going to have that layer of understanding that maybe previous generations did. And so, yeah, how that shakes out is yet to be seen. But and I think it also has impacted, we talk a lot about these consumer sentiment reports have been, the lowest they've been in 50 years, yet the labor market's still quite strong. And you wonder, well, how can that be? Everyone is, for the most point, unemployment is still historically low here in the US, 4.2, 4.3%. And so why are people feeling so badly? And I think it is partially these headlines about, worrying about AI taking their job. Doesn't help that we have these geopolitical tensions as well. But even prior to the war in Iran being, getting started in the end of February, you did have these concerns. And I think AI has lent to that. But I will say, as well, when you look at kind of the lofty expectations for corporations, a lot of what's priced into those earnings expectations, I think, is the promise of AI efficiency. Like, how can we continue to grow? You talked about profit margins at this rate. How can you continue to grow earnings at the clip that we have? And I will point out, and I pointed this out in my piece, the earnings growth rates we're seeing now are similar to what you would see after a recession, right? Because of easier year-over-year comparisons. But we're continuing to grow, and expectations are for 2026 earnings per share of about 24% growth. And that, moderates the next couple of years into the 10 to 16% range. But how can things continue to expand like this? And I think it's because companies are pricing in those AI efficiencies.
Yep, absolutely. Right, we're coming near the end and the beginning of the episode. So I want to try and get a view of the sectors you'll be looking out for in this coming earnings season. We've had the key banks. That's been a good news story. Obviously, the retailers are another big sector that we want to pay mind to, and obviously the tech outfits out there. I heard something Buffett said today that he regretted not getting into Google or getting in at the ground level on Google earlier today in one of his interviews. Looking at that tech sector, do you still look for other sectors to try and maybe catch up and to make this a more balanced stock market than we've currently got? I mean, we've talked about the Mag 7, I think, for the last 2 years that we've been of the recordings that we've been doing or whatever, and it seems to be still seems to be the driving factor amongst everything else. How do you sustain this stock market drive? And that was a big question. If you answered that, I'd put every cent. By the way, you'd have all my money. But where are the other sectors? What are you looking for from the other sectors for this quarter? Let's keep it simple.
Yeah, I mean, look, you're right. Tech is still a big driving force, but I do think there's been some broadening out amongst sectors that are contributing to this growth rate, unlike what we've seen in some past quarters where it's really been, all banking on 7 names or 8 names if you include Broadcom. And so I do see this more of some breadth here. Of the 11 sectors, 10 are expecting positive year-over-year earnings growth, all but healthcare. I think healthcare.
That's a great sign, to be honest. If the 10 of the 11 sectors, it's got to provide a bit of optimism. And so, the one sector I cut across you, the health sector. What were you saying about that?
Yeah, I mean, the health sector, it's a big part of it is Gilead Sciences. I don't cover health super closely, but I think one of their HIV drugs, they lost their exclusivity. So that was a factor in bringing down the overall growth rate for the sector. And then some of the subsidies from the Affordable Care Act are coming to expiration. And so I think there's been some impact in patient volume and whatnot. So that's maybe a broader healthcare story, but healthcare is expected to see revenue growth. Actually, all 11 sectors are anticipated to show revenue growth. That's a number I actually care a little more about because can't really manipulate sales like you can earnings per share, right? So overall, I do see, yes, tech's a leader. I mean, energy, no surprise, the biggest leader this earnings season because of what we saw with oil prices last quarter. But it's still a tech story, but you've got materials up there. You got communication services. You mentioned Google, Alphabet falls in there. Like you said, the financials, these numbers are from Friday. The financials are going to get a big boost from those bank numbers. Consumer discretionary, earnings expected to grow about 7% year over year. Revenue about 7.5%. So they're hanging in there. I mean, they're at the lower end. They're considered a laggard amongst the sectors, but they're still expecting high single-digit growth. And we don't get most of those names till the end of the season. So we'll see how that shakes out. But I do see overall, more breadth amongst the winners this season than we've seen in the last few quarters.
Okay, and that's obviously a good sign for things to come. Just to put that into perspective, peak reporting period between the 27th of July and 14th of August.
Yep, those are our 3 peak weeks. I think globally we get over 2,000 reports each of those weeks.
Okay, so the 6th of August is projected to be the single busiest reporting day. So there's still lots more to come. So just to wrap it up quickly, I'm looking at the screens now, and Fed's Walsh is there, second day of his 2-day testimony. Now he's talking to the Senate Banking Committee. Do you see any kind of influence as we wrap up there from the Fed and monetary policy on a macro level that may play a part in the second half of this year's corporate calendar, or just the effects it will have on the corporate sector?
Yeah, I mean, we're still getting to know Warsh, right? It seems pretty clear from early comments he's going to keep things more of the same as far as the hawkish tone. There's nothing here. I mean, look, they're not going to make any changes based on that CPI report their day. A couple of weeks ago, we had that weak labor report, however, but again, they're looking at more than just the 1-month trend. And so they have their work cut out for them, but I think if you look at the CME Group's FedWatch tool, not expecting any cuts this year. Will there be a raise towards the end of the year? That's still kind of yet to be seen, but certainly, as always, monetary policy is going to have a big role in what, how the economy turns out, but also how the consumer feels. And so we'll be looking forward to these comments and kind of getting to know what direction this new Fed's going in.
Excellent. Okay, well, listen, we're at the end of the episode now. Just to sum up then, so the backdrop for Q2 earnings is fundamentally strong, supported by robust profit growth and improving capital market activity. Although investors are likely to place greater weight on, as you put in your report, management guidance, particularly around the economic outlook, geopolitical risks, capital allocation, and the sustainability of earnings momentum into the second half of this year. Really. So as we are sitting here right now, all things looking fairly positive on the corporate earnings front. But again, we are at the beginning. So we have to see, like you say, we've got the peak earnings to come. We've got the retailers to come to see where the consumers at. So again, still a lot to be revealed. Christine, I'd like to thank you very much for your input today, as always.
Thank you so much for having me, Harry.
It's always a pleasure. You can find anyone who missed the start of this, you can find us on all the social media platforms and also on your podcast platform of choice. So please go back and listen to this in its entirety. We'll put up the links where you can go find Christine at Wall Street Horizon. You'll find her on a number of different places. I mean, I've seen about 2 or 3 interviews you've given this week already, I think.
Busy season, yep.
Yeah, exactly. So you can find Christine's work all over the place. We'll put up links for you. Thanks again. And listen, thank you everyone else for listening. And for those who follow the football or soccer, yeah, I'll be rushing off there to watch England play Argentina. And hopefully the next time we speak, I have some good news. But yes, everyone have a lovely evening, and we'll see you guys again soon. And hopefully we can do a sort of mid-season catch up on the earnings as well if we get a chance to.
Absolutely.
Awesome. Thank you, everyone, and see you again soon. LiveSquawk keeps serious market participants ahead of the news around the clock. Start your free trial at livesquawk.com.
Thanks for tuning into the LiveSquawk podcast. Your edge in the market starts here. Subscribe now.